An online casino can process $1 billion in bets and still keep less than $5 million for its owner. Most of the billion returns to players. The few cents left from each dollar must then pass through bonuses, game studios, payment processors, affiliates, tax authorities, fraud systems, and a compliance operation that can decide a customer should stop playing. That is the first contradiction. The casino has a mathematical advantage, but the owner does not own every dollar lost by a player. And the house always wins does not mean the business wins every month. We are going to build one hypothetical licensed online casino. It offers real money slots, computer-based table games, and live dealer tables in regulated markets. It does not own a Las Vegas hotel. It is not a sportsbook, prediction market, sweepstakes, casino, or offshore site. Our platform records $1 billion of annual wagers at a 96% theoretical return to player, or 4% house edge. If the year lands close to expectation, the billion-dollar river becomes about $42 million of gross gaming revenue. After every modeled cost, the base owner receives about $4.8 million of pre-tax distributable shares. But change the payout results, acquisition cost, and retention, and the same machine produces a $7 million cash loss. Make those variables work in the owner's favor, and it produces roughly $14.5 million. To understand why the range is so wide, start with the dollar a player deposits. That dollar is about to appear much larger than it really is. Imagine a player deposits $100. They wager $10, win $9, then wager the $9 again. Nothing new entered the casino, but total wagering has already reached $19. Across thousands of sessions, the same cash enters turnover many times. $1 billion wagered is not $1 billion fresh dollars transferred. A small public operator makes the distinction visible. High Roller Technologies reported about $557 million of 2025 real money bets, $87 million of deposits, and $20.5 million of net gaming revenue. Ontario shows the same distinction at market scale. In fiscal 2024-25, players wagered $82.7 billion Canadian dollars across casino, betting, and poker products. Gaming revenue was $2.9 billion, not $82.7 billion. The cleanest casino bridge has 4 levels. Turnover is every stake, including money that has been won and rewagered. Player win is every prize paid back. Gross gaming revenue, or GGR, is turnover minus player win. Net gaming revenue, or NGR, is more dangerous because companies and regulators do not all define it the same way. For our model, NGR means GGR minus bonuses and player rewards. Whenever someone quotes NGR, the first question should be, net of what? Deposits are a funding flow. Turnover is activity. GGR is the casino's win before many costs. NGR is a defined intermediate line, and owner cash is what survives at the bottom. The gap between turnover and GGR comes from the mathematics inside each game, but that mathematics is often described too confidently. Return to player is not a promise that one person gets 96 cents back from every dollar. It is a long-run, designed average across a very large number of plays. If a slot has a theoretical RTP of 96%, its theoretical house edge is 4%. Across sufficient play, the game is designed to return about $96 of every 100 wagered and retain about $4 as GGR. But two games with the same RTP can feel completely different. A low volatility game may pay small prizes frequently. A high volatility game may produce rare, enormous prizes. The average can match, while the path does not. That matters to both sides. A player can win heavily in one session. A casino can also have a terrible day, week, or month when a jackpot lands or a large player wins at the wrong moment. Under stable rules, actual results tend toward the designed expectation as play grows. Higher volatility requires more volume. The casino does not win every sequence. Licensed games are not supposed to secretly become stingier because a player is winning. In Great Britain, remote game results must be acceptably random. Adaptive behavior that changes outcome probabilities during play is prohibited. Rules and RTP, house edge, or winning probability must be available before a customer commits to play, and approved testing covers the game. Mathematics and implementation. The legitimate edge is already in the pay table. The operator does not need to rig individual outcomes. Yet the operator's actual annual hold will still differ from the 4% theoretical edge. Game mix changes. Players choose different table strategies. Jackpots create tails. VIP sessions can move a short period, and bonuses can change what the company records as revenue. This is why our base model uses a 96% theoretical RTP, but a 95.8% actual RTP. $42 million of GGR on 1 billion wagered. Not every casino product creates that GGR in the same way. Slots are the volume engine. A digital slot can run continuously, serve many players at once, and require no dealer at each table. Its economics depend on game-specific RTP, volatility, player engagement, and the share owed to the studio and platform. Computer table games have rule-based mathematics. Blackjack can have a low house edge under strong strategy, while realized results change with rules and player choices. Live dealer adds a social, premium experience, but someone must staff the studio, stream video, and maintain equipment. Provider cost and visible short-term variance can be higher. Then there is Sportsbook. It may sit in the same app, but it is not the same business. A sportsbook sets odds on external events. Outcomes and concentrated betting can swing the hold. Casino RNG volume is usually more statistically diversified. A prediction market is different again. It generally matches positions and earns fees instead of acting as the casino house. This episode excludes sportsbook and prediction market revenue because mixing them would make the owner model impossible to audit. It also matters who built the game. The licensed casino operator owns the customer account, accepts the wager, pays the withdrawal, and answers to the market regulator. A game studio builds the mathematics and software. A live casino supplier runs the studio. Evolution, for example, disclosed more than 2 billion euros of 25 net revenue from supplying live and RNG content. That is supplier economics, not the profit of the casino showing those games. An aggregator connects many studios through one integration, simplifying the catalog while adding another commercial layer. The casino may pay a fixed platform fee, a share of GGR, minimum commitments, or some combination. Private contracts vary, so our model does not pretend there is one industry rate. It assumes studios and aggregation together take 12% of base GGR, or $5.04 million. The casino can improve retention with more games, but every additional supplier also wants a piece of the thin channel left after players are paid. Then the operator pays to bring the player to that channel. The welcome message may say free spins, matched deposit, cashback, or bonus cash. Economically, those are acquisition and retention expenses with conditions. A bonus can reduce effective loss and encourage another session. It can also create the false feeling that bonus-funded gambling has no value. The withdrawal rules matter. A wagering requirement says how much activity must occur before bonus-linked funds become withdrawable. Britain's regulator gives a sharp example. A £10 bonus with a 50 times requirement once demanded £500 of play. From January 2026, licensed British operators may not set the requirement above 10 times, and incentives may not combine multiple gambling products. That reform does not make the bonus free. It makes the cost and condition less extreme. For the operator, a promotion is good only if the future NGR from the acquired player exceeds the bonus, affiliate commission, payment cost, and service burden. A player who deposits once, takes the offer and disappears, may never repay the acquisition expense. Affiliates complicate this calculation. A review site, streamer, search page, or comparison portal can be paid a fixed fee for a first-time depositor, a continuing share of player value, or a hybrid. Paid search, social, sponsorship, and influencer marketing add cost in channels where gambling advertising is often restricted. High Roller reported about $6.1 million of 25 advertising and promotion expense against $20.5 million of NGR. It specifically said part of its cost reduction came from lower affiliate commission per acquisition. That is one small company case, not an average, but it shows how quickly marketing can consume the edge. Our base casino spends $6 million on affiliates and paid acquisition, plus $4.2 million in bonuses and rewards. In the weak case, acquisition rises to $8 million and bonus cost rises to 12% of GGR. The house mathematics have not changed, but the customer economics have. Even after a player arrives, their money still has to pass through the payment system. A processor sees deposits and withdrawals, not every recycled spin. That distinction prevents another accounting error. Charging a card fee against the entire billion-dollar wager total would be absurd. Our base model assumes $150 million of annual deposits and a blended processing burden of 1.5%, or $2.25 million. The rate is an editorial assumption. Real cost changes with cards, bank transfer, wallets, currency, country, risk, and commercial scale. The platform must recognize deposits, preserve balances, approve withdrawals, and stop stolen cards, account takeovers, and synthetic identities. A chargeback can reverse a deposit after play. Bonus abuse may use multiple identities. A loose fraud system loses money. An over-aggressive one rejects good customers and damages retention. Cryptocurrency does not erase KYC, AML, sanctions, or source of funds risk. FinTrack warns that weakly regulated gambling sites create higher laundering risk. Our base model reserves $800,000 for fraud, chargebacks, and bad debt. The weak case raises that to $1.1 million and also pays a higher processing rate. Now the platform knows how the player paid. It must prove who the player is, where they are, whether they are old enough, and when continued play becomes a safety concern. In a regulated market, KYC is not a one-time photograph of an identity document. It is a system. Age checks screen minors. Identity checks compare data and documents. Geolocation restricts territory. AML monitoring examines suspicious movement, source of funds, and unusual account patterns. These checks create friction. Slow review loses legitimate customers. Weak review admits fraud or underage play. Asking questions only after a player wins creates an obvious fairness problem. Responsible gambling adds a second tension. The platform earns more when customers play, but a licensed operator may be required to intervene when play shows strong indicators of harm. British remote license rules require monitoring from account opening. Signals include spend, changes in spend, time, behavior, customer contact, and account indicators. When strong harm indicators appear, the operator must stop new bonus marketing and take timely action. That can mean limits, cooling off, self-exclusion, or closure, reducing activity that might otherwise create revenue. Should the casino bear more responsibility for player losses? The business cannot reimburse every voluntary losing bet and still exist. But the game had an edge is not a complete defense when the operator also controls product speed, bonus design, individualized marketing, and detailed behavioral data. The stronger principle is proportional responsibility. Disclose the odds, make withdrawal and bonus terms fair, detect harm early, stop targeted inducements when risk is clear, and submit the whole system to outside oversight. Our base model spends $1.5 million on KYC, AML, and compliance, another $1 million on customer service and responsible gambling, and $500,000 on license and legal costs. Then comes the line capable of taking more than all three combined. Gaming taxes are often charged against GGR, or a defined gambling profit base, not the owner's final profit. New Jersey raised its internet gaming gross revenue tax to 19.75% in July 2025, with an additional investment obligation. Britain's remote gaming duty rose from 21 to 40% in April to 6. 40% of remote gaming profit is not 40% of owner profit. It is taken much higher in the waterfall, before much of the operator's marketing, payroll, and technology expense. A casino can owe gaming duty in a jurisdiction, while the corporate owner produces little or no distributable cash. Every market has its own license, games, advertising rules, safeguards, tax, and technical requirements. Losing one major market removes revenue faster than shared technology and compliance costs. This is where the licensed operator diverges from an illegal offshore casino. An offshore site may avoid local duty, testing, and safeguards, creating an apparent margin advantage. It also faces payment and domain blocks, enforcement, frozen assets, and markets where no regulator can recover a player's money. Australia makes the boundary especially clear. Providers may not offer online casino games to people in Australia. By April 2026, its communications regulator said 1,140 illegal gambling and affiliate sites had been blocked since 2019. A sweepstakes casino is another category. It may use a free entry claim and dual virtual currencies to argue that it is a promotion rather than gambling. But states increasingly reject casino-style play hidden inside that structure. California's 25 law prohibits defined online sweepstakes games and can reach processors, game suppliers, platforms, and affiliates that knowingly support them. An illegal operator can be more profitable on paper precisely because the paper omits the obligations that make a market legal. That is jurisdictional arbitrage, not evidence that a licensed owner should earn the same margin. Now, we can finally follow the full billion-dollar river. Start with $1 billion of annual wagers. At a 95.8% actual RTP, 958 million returns to players. The remaining 42 million is GGR. Bonuses and player rewards consume 4.2 million. Our defined NGR is now 37.8 million. Game studios and aggregation take 5.04 million. Payment processing takes 2.25 million. Affiliates and paid acquisition take 6 million. Staff and technology take 5 million. KYC, AML, and compliance take 1.5 million. License and legal cost, $500,000. Blended gaming tax takes 8.4 million. Fraud, chargebacks, and bad debt take 800,000. Customer service and responsible gambling take 1 million. What remains is 7.31 million of modeled platform EBITDA. Then 1 million goes to financing, and 1.5 million stays in the company as a technology and security reserve. The base owner's pre-tax distributable cash is $4.81 million. That is less than half of 1% of wagers. It is about 11.5% of GGR. The owner did not keep the billion, the 42 million, or even the 7.3 million EBIT. Public companies show why no average margin should be trusted. Betson, a mature mixed operator, reported a 2025 EBITDA margin above 26%. DraftKings produced more than $6 billion of mixed product revenue, but a small operating loss. High Roller reported a $6.2 million operating loss. The house edge is necessary. It is not sufficient. The most dangerous number is actual RTP. Move base actual RTP half a percentage point higher, from 95.8 to 96.3, and the owner's cash falls from 4.8 million to about 1.9 million. The players received 5 million more, but after variable bonus, supplier, and tax effects, the owner loses about 2.9 million. Move actual RTP half a point lower, and owner cash rises to about 7.7 million. This can happen through game mix and normal variance without changing the published theoretical RTP of any game. Raise acquisition cost by 25%, and owner cash falls to 3.3 million. Raise the gaming tax assumption from 20 to 25% of GGR, and it falls to 2.7 million. If supplier share rises from 12 to 15%, owner cash falls by another 1.26 million. A $3 million VIP or short-term GGR swing moves owner cash by about 1.74 million after modeled variable costs. One customer cannot change the probability of a slot, but a large payout can still change the company's month. Does this mean online casinos depend on whales? Sometimes concentration matters, but the strongest available claim is narrower. A UK regulator sample using 24 data found formal high-value schemes generated about 3% of GGY, with large variation and more reliance in land-based casinos. It would be false to say every online casino earns most revenue from a tiny VIP group. It would also be misleading to say casinos routinely ban anyone who wins. Standard licensed RNG games already have a mathematical edge and do not require that response. Restrictions are more plausibly tied to bonus abuse, fraud, AML, terms, advantage play, or, especially in sportsbooks, concentrated risk. Operators still need fair and transparent rules and should not use verification as an excuse to delay legitimate withdrawals. The largest sensitivity is geographic. In our test, losing a market that produces 30% of wagering pushes owner cash slightly below zero, even after partial marketing and staff cuts. Licenses are not just overhead. They are permission to have revenue at all. Now compare all 3 complete years. In the weak case, annual wagers are $850 million. Actual RTP is 96.6%. GGR is only 28.9 million. Bonus and acquisition costs are high, payments and fraud are worse, and gaming tax still arrives. Platform EBITDA is negative 4.3 million. After financing and the security reserve, owner pre-tax distributable cash is negative $7 million. In the base case, $1 billion of wagers produces 42 million of GGR, 7.3 million of EBITDA, and 4.8 million of owner cash. In the strong case, better retention lifts wagers to 1.2 billion. Actual RTP lands at 95.4%. Acquisition is more efficient. Supplier share is lower, and the blended tax rate is lighter. GGR is 55.2 million. Platform EBITDA is 17.5 million. Owner pre-tax distributable cash is about 14.5 million. So, what are the economics of owning an online casino? You do not own a billion-dollar revenue machine. You own a thin statistical channel between a much larger stream of wagers and payouts. That channel can be valuable because software scales and the house edge compounds across enormous volume, but the channel is rented from game suppliers, payment networks, affiliates, and regulators. It is taxed before the owner is paid. It leaks through bonuses and fraud. It must sometimes close itself to protect the player. And it can move against expectation long enough to create a losing month or a losing year. The house has the long-run mathematical advantage. The owner receives only what survives the house.